In September 2008, the global financial system began to break. The collapse of Lehman Brothers triggered a contagion that wiped out trillions of dollars in wealth and left economists searching for an explanation. That November, Queen Elizabeth visited the London School of Economics. During a briefing on the dimensions of the crisis, she asked a simple, fundamental question: why did no one notice the indicators that it was coming? Months later, a group of leading economists delivered a formal reply to the palace. The 2008 crash demonstrated that focusing on a single, isolated metric while ignoring the interconnected system is a recipe for disaster. In March 2023, Federal Reserve Chair Jerome Powell addressed a group of students at Harvard. When asked about the primary factors that could trigger the next major crisis, his answer focused on a specific internal metric. Powell warned that the volume of U.S. government debt is growing significantly faster than the economy itself. He described the current path as unsustainable on its current trajectory. By the end of that month, the total U.S. debt held by the public surpassed $31 trillion. For the first time, the volume of money the government owes to external investors officially broke the 100% threshold of the entire American economy. Critics of this warning often point to Japan. With a debt-to-GDP ratio exceeding 200%, Japan has avoided a sovereign debt crisis for decades, leading many to believe the U.S. has plenty of room to borrow. However, using Japan's total debt to dismiss the American situation requires a specific analytical choice. We have to ask if that comparison accounts for the total financial picture. To evaluate the risk, we have to separate the U.S. national debt into two categories: intragovernmental holdings and debt held by the public. Intragovernmental debt is essentially an internal accounting mechanism. It represents money the government owes to its own agencies, which can be managed through legislative or accounting changes without affecting the broader market. The debt held by the public is the true market liability. This is the $31 trillion owed to foreign governments, international institutions, and private investors who expect repayment on schedule. Relying on the top-line national debt number provides a limited view. Assessing actual systemic risk requires looking at the entire balance sheet. This brings us back to Japan's 200% debt ratio. While that number appears high, it only represents the liability side of the ledger. Japan's financial position is unique because of the asset side of its balance sheet. While the government borrows heavily, it also owns an immense portfolio of financial holdings. Japan utilized near-zero interest rates to borrow yen at low cost, creating massive liquidity. They invested this capital into higher-yield foreign securities and domestic stocks, pocketing the spread. By 2024, the public sector held financial assets equaling 192. When we apply the same full balance sheet math to the United States, the American net liability figure stands at 83.7%. Under this metric, the United States carries a heavier net debt burden than Japan. The common comparison used to minimize American debt overlooks this systemic difference. The lesson of 2008 remains relevant. Relying on a single, isolated metric can create a systemic blind spot, obscuring the risks that exist within the total financial structure. Headlines love a big, round number, and recently, the financial world has been fixated on one. The moment the U.S. public debt crossed 100% of the entire American economy. By the second quarter of 2025, the total national debt is estimated to hit a staggering $36.2 trillion. Take a look at this chart tracking two different paths. The structural danger is found in the velocity of the debt's growth compared to the much slower pace of the underlying economy. Mapping the historical rates from 2000 to 2025, we see a disturbing divergence. Over that quarter century, the national debt grew at an average of 8% every single year. Meanwhile, nominal GDP, the actual output of the U.S. economy, only grew at 4.6%. This means the government's financial obligations are expanding nearly twice as fast as the economic engine required to fund them. Every year, the gap between what America owes and what America actually produces gets a little wider. The United States has essentially trapped itself in a mathematical corner, permanently losing the structural ability to simply outgrow its financial obligations. Why is the debt accelerating so rapidly while the economy lags behind? This divergence is driven by a mechanism called diminishing marginal returns on debt. As a government borrows more and more, each new dollar it takes on does less and less actual work for the economy. Historically, the system worked because a borrowed dollar was put to work. It was invested in long-term capital assets, like highways, research, or heavy infrastructure. That single borrowed dollar would multiply, generating a dollar or more in actual GDP. But that baseline has collapsed. Today, each newly borrowed dollar yields only a few cents of economic growth. Instead of being invested into a foundation for the future, the money is consumed almost immediately. Borrowing trillions of dollars no longer translates into national wealth. The U.S. has shifted from an economy built on strategic investment to one trapped in the daily grind of servicing its past deficits. If the borrowed money isn't building anything, where exactly is it going? It's being swallowed whole by massive, expanding budget deficits that require even more debt just to keep the lights on. The first major drain is the cost of the debt itself, the interest payments. In the 2026 fiscal year, net interest payments on the national debt are projected to exceed $1 trillion. This chart shows exactly how fast that specific burden is exploding. Back in 2020, the government paid $345 billion in net interest. The projected $1 trillion payment for 2026 is nearly triple that amount in just 6 years. To put that immense scale into perspective, in just the first 3 months of the current fiscal year, the U.S. paid $270 billion in interest alone. That is more money than the country spent on its entire national defense budget over the same period. And defense itself is the second major non-productive drain, specifically massive external military spending by the Pentagon. When the government buys munitions and tactical equipment that are rapidly consumed or destroyed in overseas conflicts, it leaves absolutely zero domestic capital behind. There is no factory, no bridge, and no physical asset left on American soil to generate future revenue to pay off the debt. Federal Reserve Chair Jerome Powell recently addressed this reality with Harvard students. He noted that the government strategy isn't actually to pay off the debt. The only plan is to achieve a primary balance by getting the economy to grow faster than the debt. But the government's consumption-heavy spending choices, burning capital on interest and overseas conflicts, inherently prevent the very economic growth that Powell admits is their only possible escape route. Extrapolate that mathematical trap forward, and you hit an inevitable conclusion. Harvard economist Kenneth Rogoff has been warning about exactly where this specific trajectory leads. Rogoff developed a historical framework that outlines the precise preconditions required for a sovereign financial collapse to ignite. He points to 3 mandatory criteria that must be present: fragile national finances, high interest rates, and a paralyzed political system. Rogoff contends that the U.S. already meets these criteria, citing a political environment where no serious incentive exists to curb new borrowing as evidence of that paralysis. According to this historical model, the fuel is already pooled on the floor. The only element missing is the spark, a sudden, unpredictable economic shock to ignite the crisis. Once that shock hits, the potential outcomes are severe: crippling austerity measures, massive runaway inflation, or even a partial default on the government's financial obligations. When this mathematical trap finally snaps, can the U.S. survive while maintaining the dollar's global supremacy? Or does this moment mark the definitive end of the American empire?